Hello, in this video, we'll be going through restricted stock awards and restricted stock units. Let's talk about share-based compensation. Share-based compensation are a form of payment that employers pay their employees, and it is dependent on the value of the company's stock. So it is not cash. There's different forms of share-based compensation. There's different types of plans. There are stock award plans, stock option plans, and stock appreciation rights plans, and several other kinds. In this class, we're going to go through the stock awards plans and stock option plans and how to account for them. And the goal of incentivizing employees with share-based compensation is that by providing the employees with a company's stock, they will be motivated to perform better in order to drive up that stock price, because the higher the stock price, the higher their potential compensation can be. And so from an accounting perspective, we have two objectives when we account for this. Number one is we have to determine the fair value of the compensation that the employees are receiving. And number two is how do we expense that over what period of time. So let's talk with two different types of restricted stock plans. There's going to be a restricted stock award and restricted stock units, and we're going to go through both of those in this video. First, let's talk about restricted stock awards. So just to be clear, restricted stock awards are a type of restricted stock plans. And in the restricted stock awards, the company's shares, like stock, is actually issued in the name of the employee, but it is subject to restrictions and forfeiture exceptions. So while there are restrictions in place, the employee cannot sell or transfer that stock, even though it's in the employee's name, and they have to vest in them in the stock. And the vesting means that there's a certain period of time that the employee has to work, and if they work that time frame, whether it's 2 years, 4 years, whatever is determined by the company, once they hit that time frame, then they are vested in those awards, restricted stock awards, and then they can do whatever they want with that stock, because it is officially theirs. Up until that point, up until the stock vests, even though the stock is in the employee's name, it is retained by the company in an escrow account. And if the employee terminates the employment, right, without vesting, meaning they terminate before a certain number of time has passed, which is stated in the restricted stock plan, then they basically forfeiture those stock awards and they never get those that stock. So how do we account for restricted stock awards? One, we have to determine, like I said, the fair value of the compensation, and then we have to expense that compensation over the periods in which participants, meaning the employees, perform related services. And actually, it doesn't actually only, I keep saying employees, but you can award restricted stock awards to non-employees. Like the board of directors are not employees of the company, but oftentimes they too will get some sort of restricted stock plan in effect. But the expense is going to be recorded on the income statement over the periods in which the participants perform their service that they need to, whatever that service may be. And so when we record this journal entry for restricted stock award, because we're actually issuing stock, we credit common stock and paid-in capital in excess of par for the fair value of that restricted stock. And then we have a debit to a contra account, which we'll go through in an example. Here's the example. Under its restricted stock plan, Universal Communication grants a restricted stock award or restricted stock units representing 5 million of its $1 par common shares to certain key executives on January 1, 2027. The shares are subject to forfeiture if employment is terminated within 4 years and shares have a current market price of $12 per share. Let's go through what happens if this is actually a restricted stock award. So just for this first part, we'll assume B is not relevant, that they've issued restricted stock awards, $5 million at $1 par common stock. So on the grant date, Universal calculates their compensation as follows. Okay, on the grant date. So the grant date is the date that they were granted those shares, and their vesting date is usually different than the grant date. So the vesting date will be when they actually have that stock, even though it's in their name, that they have freedom to do what they want with it, whether to keep it or sell it or transfer it. So, okay, so on the grant date, we'll look at the fair value per share, which we're told is $12 per share, times the number of shares awarded. So in total, there's $60 million of compensation. And we're told that the shares, right here in the first bullet point, the shares are subject to forfeiture if employment is terminated within 4 years. That means we have a 4-year vesting period. So we have to allocate that $60 million over 4 years, because that's the service period that the participant has to work for the company in order to receive these shares in full. So we're going to do 60 million divided by 4 is $15 million a year. So that's the fair value. Okay, 60 million is the fair value and 15 million is the compensation expense per year. So on January 1, we're going to record the total fair value of the grant, okay, which is 60 million. So we're going to record this contra equity account called deferred compensation for 60 million. We're going to debit that. We're going to credit our common stock for par times the number of shares that we've issued, which is 5 million shares. So we're going to credit it by 5. And then the rest, as a plug, goes to paid in capital in excess of par for $55 million. Okay, so this debit, this contra equity account, means that it goes in the equity section, but its normal balance is a debit, whereas usually an equity account, a stock account would be a credit. So notice what's happened so far. We have a decrease in the equity account and then an increase in equity account. So in effect, there's zero impact to the equity section of the balance sheet. Now, at the end of each year, as this, because it's a 4-year vesting award in this situation, we're going to recognize $15 million of compensation expense each year. So at the end of each year, we're going to debit compensation expense for $15 million, and then we're going to credit this contra equity deferred compensation account by $15 million. So if you draw it out in a T account for this deferred compensation account, this contra, we debited 60 million on 1/1/27, and then we're going to credit 15 million over the next 4 years. And so at the end of the 4 years, there'll be nothing left in that account, and we've expensed $15 million of compensation in the income statement for 4 years. Now let's look at a restricted stock unit. One of the biggest differences between restricted stock awards and restricted stock units is that in a restricted stock award, stock is actually issued, right? The employee can't do whatever it wants, but it is issued. The stock pays dividend to the employee, even though they haven't invested in it yet. In the RSU, restricted stock units, no stock is actually issued. It's what the employee or the participant receives is a right to receive a specified number of shares of company stock once they've reached their vesting requirement. Okay, so no stock is issued. And the benefits that they receive is the value of the shares at the end of the vesting period. That's the recipient gets that, the employee or whoever it is. And the company actually distributes the shares, which means they'll actually issue the shares once the recipient satisfies the vesting requirement. So just know that RSUs is what restricted stock units are known for. You can, recipient or participant can be given just the actual shares or a cash equivalent of the number of shares. And the terms of the plan will stipulate how the employee or participant will receive those RSUs. Will they receive in cash or will they receive it in actual stock being issued? Here you can pause the video to see a note from T-Mobile how they discuss their share-based compensation, specifically that they're issuing restricted stock units. Let's go back to that same example, except now we're just going to look at as if the company had issued restricted stock units. Same facts. They're $5 million at $1 par common shares. They were granted on January 1. They're subject to 4-year vesting, and the shares have a current market price of $12 per share. Well, whenever we look at restricted stock plans, first thing we do is we have to calculate the fair value of the compensation, and that's calculated the exact same ways as a restricted stock award. The fair value per share times the number of shares awarded. So in our situation, we still have $60 million of compensation, okay? And the vesting is still 4 years, so we still need to recognize $15 million of compensation expense per year for the next 4 years. The manner in which we do that is different though. Restricted stock units, because RSUs are rights to shares in the future and no shares have been issued on the grant date, which is when they've received those rights for future shares, there's no entry because we haven't actually issued those shares yet. At the end of each year of the vesting period, because there's a 4-year vesting, we're going to debit compensation expense for $15 million. And then we still haven't issued the stock, okay, because they have a 4-year vesting and they only get it at the end of the 4 years. That's called cliff vesting. And we're going to park the credit in this account called paid-in capital restricted stock. And that's lumped in with all the paid-in capital accounts and into that bucket and be reported as one amount on the balance sheet on the 10K. Now, we do this every year. The first journal entry, number 1, we do that at the end of each year. So by the end of the 4 years, we have expensed $60 million, which is the fair value of these RSUs. Now, on December 31, 2030, the 4-year vesting has passed, right? Because if you look at 1/1/27 to 12/31/30, that's 4 years. 1, 2, 3, 4. Now we've actually can issue the stock to the participant. So we're going to debit this paid-in capital restricted stock. So we're going to reverse this account right here. And now we're actually going to issue common stock. So we're going to credit our common stock account equal to the par value of the common stock multiplied by the number of shares issued, which is 5 million shares. So we have 5 million credit, and then the rest goes to paid-in capital in excess of par for $55 million. Let's go through a concept check. Zarshena's Jewelers granted restricted stock units representing 120 million of its $1 par common shares to executives, subject to forfeiture, okay, if employment is terminated within 4 years. So they have a 4-year vesting requirement or else they get nothing. After the recipients of the RSUs satisfy the vesting requirement, the company will distribute the shares. The common shares had a market price of $5 per share on the grant date. The total compensation cost pertaining to the restricted stock unit is what? Now remember, RSUs, restricted stock units, are just the rights to shares versus the restricted stock awards is when shares are actually issued. Okay, I just want to keep reiterating that so you can actually remember that. But that's not the question. The question is, what's the total compensation? Well, the total compensation is going to be the number of shares granted multiplied by the fair value of those shares on the date of grant. So we're going to take 120 million times 5, and that's going to give us $600 million. That's the total compensation. And then the company has to recognize that compensation over the vesting period, which is 4 years. Now, question, what if this exact same question came about, except it says that Zarshena's Jewelers granted restricted stock awards? Would our answer change? The answer is no. The total compensation is the same. It's the fair value of the shares that are either being awarded or the rights to the shares. It's just the manner of the way it's recorded on the grant date and the vesting date at the end of each year. Not the vesting date, at the end of each year within the vesting period. Okay, another last final concept check. Garavelli Industries granted restricted stock units representing 60 million of its $1 par common shares to executives, subject to forfeiture if employment is terminated within 3 years. So now we have a 3-year vesting. After the recipients of the RSUs satisfy the vesting requirement, the company will distribute the shares. The common shares had a market price of $8 per share on the grant date. Ignoring taxes, what is the effect on earnings in the year after the shares are granted to executives? Okay, so in the year after the shares are granted. So in this situation, they're not asking for what's the total compensation. It's really, they're asking what's the effect on earnings in each year, right? Within the 3-year vesting period. In that situation, we're going to take the number of shares that were granted, right? Multiplied by their fair value on the date of grant, which is 60 million times 8. So that gives us the total compensation is 480 million. But we're going to record that compensation expense over the vesting period, which is 3 years. So we're going to record $160 million of compensation expense each year. Okay, and again, that's going to be the same for an RSU or a restricted stock award. We're going to be expensing $160 million per year. Just the way it's recorded is different.